Well, it seems like everybody is jumping in on this housing correction bandwagon. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick in the house, putting the realism back in real estate. Today is October 24th. It looks like the month is just about over here, guys. Lots of changes in housing. We're going to talk about it in a second. But first of all, if you want some information as to what's going on in the housing market and what my take as to what's really going to happen, then just send me an email and I'll give you my report. It's called the Bubble to Correction, then Crash to Crisis, How the Housing Market Imploded in About 6 Months. Send me an email right there. I'll send you the report just as quick as I can fire it off to you guys. So there you go. Anyway, a very interesting sort of news article came out. This is I guess, a report out of Fortune magazine. As I did mention, Fortune magazine has been producing some pretty good stuff with respect to what's happening in the housing market. So I'm kind of actually impressed with sort of what they're doing. I don't often say that to a lot of publications, but they've really been, I think, lately one of the best out there at providing what's really happening in today's market. So today it's the housing stunning downfall in one chart. Prices have plunged in 51 of these 60 cities, and there's much further to fall. So this is based on an article in the report from the director of at least the housing section of the American Enterprise Institute. So the American Enterprise Institute does produce all sorts of white papers and reports and analysis on the housing market, among other things. I used to follow them quite regularly back the past few years because they would produce on a monthly basis the FHA delinquency report that would give us the top 10 locations, with delinquent numbers and seriously delinquent. Then I guess that got a bit too cumbersome and they moved that to a quarterly basis. Well, they haven't produced that since really the end of March. So we don't know how those delinquencies are doing anymore. And to be quite upfront, the AEI, the American Enterprise Institute, has kind of chosen to go down a little path here, which I'm not going to say the words because I'm sure there's some artificial intelligence that triggers on specific words, but they've kind of gone down a specific way of looking at the market, which really, changes the dynamic of how things are being, I think, portrayed and what the information is coming out. So having said that, basically, they're producing this information. We can take a look at it. Basically, we're going to take a look at a big list here. Remarkably, all the big decliners were rocking as recently as April and May. So this just didn't happen overnight. A lot of the stuff, or a lot of locations, the metros are losing home price appreciation and declining. They were already showing signs of that prior to the summer selling season, and we can take a look at that. So basically, here's the U.S. metro areas where home prices are falling. Now, I'm not exactly too sure, like he's talking about September, but I believe this data, when you look at some more information, I'll show in a bit here, the data really is from like a July-August time frame. So that's why what you see here is interesting, but you're going to see some of the markets down towards the lower end of the 50 or 60 that you think, oh, that's not much. And so I can tell you that those markets have already changed over the past couple of months as we go forward. So the big loser, I guess, is the San Jose area, San Francisco area, Seattle, Denver, San Diego, Portland. So let's take those right off the top there. Those are Northwest, like West Coast, Northwest. Clearly, a lot of appreciation over the years. So you're going to see when markets change, the people or the cities and metros that had the most appreciation, conversely will have, the most obvious or early signs, or you'll see it there, it happening there first. So there's no surprises here. Las Vegas, Nevada, Phoenix, Colorado Springs, Sacramento, LA, Tucson, and then Washington. So basically, that's about top 13 right there. Pretty much everything is West Coast, Central West Coast, as opposed to Washington, D.C. But again, as I said, take this with a grain of salt because I'm sure these numbers are worse right now. This is almost in a bit like Case-Shiller. They're going back a couple months to actually compile the data. So when you take a look at the next bit, Riverside, California. Riverside, always a hotbed for pre-foreclosures. Boston, Charlotte, Nashville, New Orleans, Pittsburgh, Minneapolis, Miami, Raleigh, North Carolina, Birmingham, Alabama, Omaha, Nebraska, Philadelphia, Providence. So we're pretty much seeing a lot of the major metros across the entire U.S. here. It's not, even though the top ones are concentrated in the Northwest, we're seeing a lot going on. Boise City, Idaho. I can tell you that Boise has had the most appreciation over the past couple years, and that's why when I look at this number, I'm thinking, okay, they've probably dropped way more than that, what they're showing there. Kansas City, Missouri, Jacksonville, Florida, Cape Coral, Florida, Salt Lake City, Utah, Cleveland, Ohio, Baltimore, Maryland, Virginia Beach, Virginia, Palm Bay, Florida, Northport, Columbus, Ohio, Austin, Texas, Oklahoma City, Oklahoma, Dallas. All right, so that's what we got going on here. And then Atlanta, Richmond, Tampa is where I'm at. Obviously, San Antonio, Louisville, Chicago. I mean, Chicago, with the number of pre-foreclosures in Chicago, the number of people that are leaving, I'm assuming the price points are probably, they've got to be reducing much greater than what we see. Maybe it's more the higher priced end and the higher priced burbs that are keeping that alive. New York, obviously New York City, Houston, Texas, Charleston, South Carolina, Detroit, Michigan, and Deltona. That's your top sort of top tier locations that are showing home price declines according to the American Enterprise Institute. So the cool thing about it is that, obviously we see concentration, but it's not like it's one area. This is showing a representation pretty much across the country. Every major metro, every major city in each state really showing some sort of decrease in home values. And again, this is just based on some of the summertime, July, August data. We know that once the summer selling season's over, because it was very underwhelming, that stuff like this is going to pick up, and we're going to see bigger home price declines at a faster pace as we move forward. So from the start of the downturn in July, prices have fallen 2.1% through September for the nation overall. He deploys data from a mortgage marketplace platform, Optimal Blue, to forecast where housing's headed over the next 2 months. Optimal Blue collects prices for newly signed contracts on sales that will close in around 45 days. The Optimal Blue numbers augur losses of whatever, 0.6% October, 0.8% November, taking the midpoint of 0.7%. Prices are now falling at an annualized rate of roughly 8%. So that, some of the other people that have already chimed in before American Enterprise Institute was basically saying on a just generic scale, we're looking at about 10 to 15% home price, depreciation going on. So if you think about it, prices are now falling at an annualized rate of 8% on this group. Well, and that's based on newly signed contracts on sales that will close in around 45 days. So they're actually doing a bit of forecasting as opposed to what's looking behind and true close comparables. But either way, numbers aren't far off. The cool thing about this is I think that, everyone's estimate as to where things are going to go everyone's hedging their bets. As I've said earlier in many videos, nobody wants to be the town crier. Nobody wants to come out and say, listen, our market's going to tank 50%, all hell's breaking loose, sell, run for the hills, the whole bit. Sky's falling. Nobody wants to be that person who calls it out so blatantly. Why? Because if you're wrong, you look pretty foolish. Simple as that. But it's almost like every month or every article I'm reading as time goes on, that bars tends to get a little higher now. Like, it was 5 to 10%. Now it's 10 to 15%. Now it's 20 to 25 or 25 to 30 in bigger markets. So it's almost like they're sort of edging us into, or what's what I'm looking for, like whatever. Well, just, slowly, massaging us into this, new way of thinking, which is fine. Because it was the reverse before. It was everything's going to go up double digit. Look out, keep going. Now it's the reverse. It's almost like we don't want to see the sticker shock, or they don't want us to see the sticker shock, and that maybe we should still be buying properties now at higher rates and no wait for you to buy it when it hits the marketplace low. Now, this is the worst. I guess the number one thing lenders, any real estate company, etc. What they don't want you to do is to wait. They hate the fact when people go, I'm going to wait till I see material price decreases. I'm going to wait till I see something, then prices come down a certain percentage point before I buy. They don't want you to do that. They want you to keep buying to keep everything moving. They don't want this slowdown and to further, I guess, accelerate the crash. They'd like us not to do that, but it seems like that's what's happening right now in the marketplace. So Pinto predicts that the damage will spread from West Coast to the low and middle markets, especially in the Northeast. Well, basically, that's what happens. Like we're seeing on that red chart, that the top 10, 15 locations are primarily West Coast, or like when I throw Denver in there and Vegas, to me that's West Coast, or something, Colorado's a little different obviously, but those are the higher appreciating markets that are going to lose the most, the quickest. Then it's going to work its way through. That's because high income buyers borrow in the private markets when the rates increase. Actually, sorry, the expensive parts of the market are the first to decline because they suffer the most when the Fed takes away the punch bowl and raises rates. So of course that when we see home price slowdowns, it's usually going to be in the higher tiers or the people that have pushed the envelope to get to a higher price point. They're going to have to retract and reduce if they want to maintain sales going on a going forward basis. What they say, that's because high income buyers borrow in the private markets. When the rates increase, they have a harder time qualifying for home loans than lower and middle income borrowers who get Fannie Mae, Freddie Mac, and FHA loans. Because don't remember, those loans are a little more accessible. Sometimes they have FHA loans have lower qualification standards, and some of them can have higher loan limits. So that's why you can jump in. But you can see that. Anyway, I'm just saying that's just, I guess, a good observation what they're saying here. So basically, the low and medium price categories are showing more resilience than the high end. Again, as I said, FHA requires less stringent income standards in the banks, and the West had the earliest corrections, and those corrections will continue to spread across the country. He sees two trends that could put pressure on prices in the mainstream housing. First, unemployment isn't a story yet, but it will be. We're still at record lows. If joblessness increases substantially to say 6 or 7%, we'll have more foreclosures and distressed sales. Inventories will go up. That process is only in the earliest days now. But listen to what he's saying, though, with respect to unemployment. And I don't really comment about that on this channel because I'm not really an economist, clearly. I don't really talk into that. But I still personally look at all these signs. And yeah, we have, unemployment's kind of changing. We have a lot of people who have chosen not to work, or they're trying to figure stuff out, but that number is going to go up higher. So again, as economies change, as inflation goes up, recession comes in, you're going to see more people who will be unemployed for various obvious reasons. And then, as I said, we're in the early days now. So these guys are not just doing housing; they're looking at other economic factors that are indicating that we're going to have some problems here. They're already raising the flag on the unemployment side. The second risk is the rise in gasoline prices. Now, we've already had a significant rise in gas prices, certainly some places worse than others across the country, or simply the continuation of wallet-draining cost energy in states where it's super expensive right now. Now, this is interesting to note. Rising gasoline prices are often the canary in the coal mine for a drop in housing prices. People who drive a long way to work because they move far from a city to find an affordable home will say, I can't afford to live this far anymore. They will put their homes in the market and move to a rental. That trend increases inventories and decreases demand, further depressing prices. Very interesting. So gas prices high, commuting cost high. You don't want to spend an hour and a half in your car commuting each way, paying through the nose for it. Time to make a change. I think that's kind of interesting how they say that. The combination of rising unemployment and gas prices will either wax or stay at their current levels in states where they're already extremely high, such as California and Illinois, and would send low-priced FHA homes on a sharper downward trajectory, predicts Edward Pinto. So there you go, guys. Very interesting, to say the least. And by the way, if you guys appreciate the information I provide on my channel, if you could please help it grow and hit the subscribe button, I thank you very much. All right, let's move forward here. This is some of the detail from American Enterprise, and I wanted to show this here. Basically, we're showing home price appreciation, and it's just basically showing us, here we are into, obviously this chart goes back from January 13th to where we are today. You can see how it's, lower, a little bit up, a little bit down, and then obviously it's gone up pretty significantly, and now it's kind of on its way down. With respect to, the home price appreciation, you can see that, obviously the lower end home prices typically appreciate at a faster pace than the high end do. But when you have slowdowns, it's the higher end that has the fastest slowdown in sales at first, because clearly there's less people who are going to qualify, afford, or want to pay those prices in the housing market. So interesting that they're looking at, as each month goes on, they expect home price appreciation to slow. So every month, it's actually the year over year is still going up, but that amount is shrinking to the point where, we can almost call it like it's starting to depreciate now. So interesting enough, year over year home price appreciation varied significantly among the 60 largest metros. So you could see, where, essentially it was up. So it's up in places like Florida and Texas, but it seems to be down in a lot of other locations. Now, yes, people are changing, and this is a timing thing. So we're talking about this in August 2022, right? So when you take a look at the highest home price metros, Cape Coral, Northport, Palm Bay. Well, guess what? The rapid pace of HPA decline continued in August with a rate of 11.3. Of the 10 fastest HPA metros, 8 were in Florida. I guess you could say, Cape Coral, Northport, Palm Bay, Miami, Tampa, Orlando, Deltona, and Jacksonville. But what happened in August? Nothing happened in August in Florida. What happened at the end of September? Hurricane happened, Hurricane Ian. So I can tell you that, we're going to see, like, September's numbers will probably still be decent. Why? Because the hurricane happened at the end of the month. But once it's over, now we're going to be right in the middle of the fall, and we're going to now have less closings, people not closing, things changing, and cheaper price homes coming out with respect to the damage and everything that goes along with having a hurricane run through the state. So that's why this is interesting to note where they're at on the Florida market, but Florida market will be changing very quickly right now. And again, if you take a look at this, we were already seeing, home price appreciation August 22. National month-over-month HPA in August was negative 1.6%. So it was decreasing on a monthly basis. Expected to keep declining in September and October based on that optimal blue data, whatever they're getting that data from. Essentially, number of largest 60 metros experiencing negative month-over-month home price appreciation. So obviously, 45 of the 60 experienced it in 2022, 17 in 2021, 3 in 2020, and 24 in 2019. So we just look at that number here. So we have 45 right now. Of the top 60 markets there, have home price depreciation going on. Right, only 17 in 2021, only 3 in 2020, and 24 in 2019. Why this is interesting? Because 24 in 2019, okay, just before COVID hit, we were actually bubbling. All right, I read a lot of reports that people were saying, hey, 2018, November 2018 was like our ultimate peak, and then COVID came in 2019, well, actually 2020. So we were already bubbling. We were already seeing some markets that were cracking. Foreclosures were rising, but in came COVID, and therefore we had a complete choke and handle on the real estate market. Plus, we also had foreclosure and eviction moratorium going on as well too. So the market was kind of manipulated to keep things above the board, which we're going to be obviously seeing that through now and how it's going to play out. But the point is that 24 we're experiencing negative growth, and then suddenly that changes because of COVID and the stranglehold we had in the market. So don't let this fool you. There already was signs and cracks showing before we had COVID. I've had my videos on since about 2018-19, and I was seeing that because I track these trends religiously. And if it wasn't for COVID, we would have already been going through this year. So interesting to note, that's just what's going on in the marketplace right now. Months remaining inventory. This is where I'm kind of concerned through because, again, real estate statistics, they're very difficult on all levels to obtain. And I don't want to sort of rain on people's parades or crap on them, but it's a difficult number. Everything from forbearance to delinquencies to foreclosure stats to whatever, it's tough to get a handle because a lot of it is really, kind of sampling, extrapolations. It's difficult to get really good data. Well, they're talking about months remaining inventory for August 2022. And we could basically see here that if you take a look at the little chart on the right, it says months supply by price tier in July. So the overall supply in 2022 was 1.9 months, according to what they're saying. Obviously, the low end had less, medium less, not as much, or not as low, medium high, a little bit more, and the high end obviously a little higher. But the overall was 1.9 months. Well, you take a look at that, and so they've broken this down by price tiers. When you go to the next slide here, this is what was produced recently by National Association of Realtors, so NAR. When they do their existing home sales information on a monthly basis, they do this month's supply. You can see that in July we're at 3 months. August, we're at 3 months. September, we're at basically 3.1 months. So it kind of, it's 3 months is not, if you want to go back here, they're saying, based in price tier in July to August, we're talking 1.9 months overall. So that's a little bit different than we're looking at July, August, and September here. July being 3, August being 3, September being 3.1 months. So there's a difference in inventory. So again, are they looking at home prices being single family homes versus a combined, which includes things like townhouses and condos and the NAR information. So we don't know how these are being broken out. So just again, as I say, take it with a grain of salt. NAR tends to, I think, group things, whereas they may be, AEI may be looking at just single family. So I don't really know. So this is where, just again, my point being, this is where you can see some differences in data. So it's very hard to kind of get our hands around this. But my point, though, if you look at the NAR trajectory, we can see that since January, we've kind of slowly been working our way up from 1.8 months worth of inventory to 3.1 months. For those of you that don't understand the inventory concept, so we could say that there was there's a million properties for sale on the multiple listing service, the MLS, across the board. But what NAR tends to do is they look at it in a time factor. So if you took all of the active available listings across the country and everyone's MLS, and you basically said, how long would it take for those listings, all those to sell out if no new listings came on? That's where you get this monthly time thing. So according to NAR, they're predicting that there's 3.1 months worth of inventory here across the country. So if no new listings came on going forward, it would take about 3.1 months to sell all those properties, and we'd have nothing left. That's where it is. Now, real estate gurus, pundits, economists, whatever, tend to say that 6 months of inventory tends to be a balanced, enough balance, for buyers and sellers. It's a balanced market. There's nothing is not one favor each other in that capacity. So this is sort of what they're talking about here. But again, I just want to chime in that let's put this in summary here. Okay, they're talking about it now. They're trying to show some numbers here. They're showing those red charts are showing some real graphics. We've had Fitch Ratings talking about home price depreciation, where it's going. Goldman Sachs talking about it. Moody's has talked about it quite a bit, and actually they're producing a lot of charts, and which I've shown on these videos. And Moody's actually is one of the groups that is going out and talking about 25 to 30% in some of the larger metros that have really appreciated. So we can see that this is yet one more group who wants to chime in. We're at the point now where I guess people don't want to be in a situation where they're saying everything's going to be okay and it's not. Or I think the general public or the home buying public, the American public here in the country, we kind of saw what happened over the COVID pandemic era, how it affected the marketplace for better or worse. I think we're at the point now when you have high interest rates, just the high price points. People don't want to pay those anymore. People aren't going to do it anymore. And now we're ushering in a different type of marketplace now that's going to have a lot more issues that ultimately will be driving price points down. And nobody wants to be on the other side saying, no, don't sell, or keep buying that house and keep paying premium for it because things are really going to change, which, as I said, far cry from what was talked about earlier this year. So there you go, guys. That's the scoop for what I got to talk about today. Let me go to the next slide here. So ultimately, in the end, if you want to see what's happening in your neck of the woods with respect to your own zip code, with respect to pre-foreclosures, short sales, tax deed auctions, sheriff auctions, whatever, go to gethousingdata.com. That's gethousingdata.com. That is my affiliate link with foreclosure.com. They're the leading supplier of distressed property listings across the country. So go to gethousingdata.com. And as well, what am I looking for? Agents to join my firm. Why? Because we're becoming busy now here in Florida. We got a lot more short sales we're working on. Things are actually happening. The one thing I can tell you guys is that I'm actually in the field. I'm talking to homeowners. We're actually doing this type of business. Okay, it started. I saw a dramatic pickup once Labor Day hit, which I figured that's when we would see it. A lot more leads coming in. I'm starting to work with a lot more sellers here. Things are changing, and yeah, it's going to take still a couple months for the sellers to kind of wrap their heads around what's going on here, and the fact that people aren't just showing up with a wheelbarrow full of money to bail them out of their problem. But you know what? It's got to start someplace. So again, read the stuff I'm looking for. If you want to get involved, give me a shout. I obviously have a new course now. It's a new training program. It's called Foreclosure Fortunes, a lot more broadly based than my short sale stuff was. Of course, it's going to have all the short sale information on it. We've got new tips, tricks, and techniques of how we work the marketplace. Great ideas, stuff going forward. This is the opportunity, as I said. once-in-a-lifetime opportunity. Oh, wait, this is the second chance at a once-in-a-lifetime opportunity if you didn't participate in the first housing crisis. So you can go from there. You want to reach out to me? There's my email. Just send me an email with your information, your phone number. We'll chat. I'll tell you what's going on, and I can help you any way I can. So once again, thanks for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And I look forward to speaking with you later this week. Take care.